In this video, traders, we're going to look at useful investment terminology. Stay tuned. Hey traders and investors, warm welcome to you. So if you're new to the stock market world, if you're new to investing, there's some useful terminology that you might have heard on some of the financial channels or read in the financial newspapers. I've not got around to sticking them in Google. So this 5-minute guide, we'll run through them and hopefully it'll be of some use to you. Okay, let's go. So investments, we've got common stock, preferred stock and bonds. So common stock is basically just like owning a portion of a company. You buy a handful of stock, let's say you buy 10 shares in a company, you own 10 shares of that company. There may be a multiple amount of shares in issue. You own whatever percentage that is divided by the total number of shares in issue of a company. Pretty standard stuff. You receive a dividend. For that, you have some voting rights. As your shareholder, you can have some shareholder votes. Most of the time, it's one vote per share, but it varies depending on what you've got. Now, preferred stock is slightly different. It gives you a higher dividend, or can give you a higher dividend. No voting rights. However, you might get preferential treatment should the company go bankrupt. You are going to be further up the queue than common stockholders. Bonds are basically a loan to a company. You basically loan the company or the government money and you get in exchange for it a note which says we will repay you X plus a level of interest, and that's set in the bond. So what about structures? Look at structures. Mutual funds. Mutual funds, you've probably heard of these, you may well be familiar with them. It's basically a pool of investments where people decide, a mutual fund manager says, you know what, I'm going to allocate some capital to this stock, that stock, and that stock. You pay a fee for him to do that. He goes away and invests on your behalf, and you own a chunk of that fund, which is then split up into multiple investments. You then liquidate that, then some stocks are liquidated depending on the size of obviously your investment relative to the fund to pay you back if money goes in. Then little bits of stock are bought so that it spreads into a big pool of all the amount of money they've got. They're investing in individual assets based on their belief whether that asset's going to go up or down. ETF is an exchange traded fund. It's basically it trades like a stock. So you have a stock like Apple, you got a stock price. An ETF will have a price like that. But within the ETF, it's again a fund that's investing in multiple different stocks under one umbrella. So for example, let's say you had a fund, an ETF that was trading in financial stocks. So you would have just one fund that was traded like a stock. That's why it's called exchange traded. So it would be, the value of it would go up and down. But the actual fund would be investing in, let's say, 10 to 20 different financial stocks of different weighting. So you'll get an exposure to all of those stocks within the fund, but you're only paying on buying one specific stock itself. It's a good way of getting exposure to specific things, and that can be things, a multiple array of things. I've done a video on ETFs before, guys, but very briefly, it can be financials, it can be a whole index, it can be the oil sector, it can be the oil price, it can be gold price, it can be all these kind of things. So loads of different ways of trading, or different vehicles, different exposure you can get with ETFs. Index funds are similar, and index funds could also be an ETF tracking the index. So instead of going with a mutual fund or going with a hedge fund and you're trying to stock pick, literally an index fund just tracks the index. So it tracks the FTSE 100, it tracks the S&P 500. These fees are normally much lower because it's very easy to manage. There's no management involved in it. It's just literally buying the right proportion of the index so that your fund delivers the same return as the index. There's no thought process involved in it, unlike a mutual fund where it's a consideration as to where to allocate assets. Hedge funds, a bit more complex than the mutual funds. Pretty much they can invest in what they like. They may well do some short selling. They may well buy on margin. They may well invest in other things depending that are completely outside the stock market world. You've got free reign as a hedge fund manager, depending on obviously what you've called the fund and your direction and what you've decided your investment criteria are going to be, but ultimately that's the case. And often hedge funds are compensated based on performance as well as a management fee. So they call it 2 and 20, 2% management fee, 20% on all profits is paid to the hedge fund manager or hedge fund company. A real estate investment trust. This is a way of getting exposure to real estate without having to worry about buying land, buying property, maintenance, all that kind of stuff. It's all all done for you. Again, pool of money brought in. So let's say you're investing in hotels or commercial office building or industrial or whatever it may be, that you'll invest in this fund. This is a pool of money that then goes out, the manager goes out and buys, allocates assets. So let's say he buys a hotel, let's say he buys some industrial units, does everything you need to do to run that business. So finds the tenants, does the repairs, all that kind of stuff. And the bottom line profit, if you like, is or the yield or the rental is probably distributed in dividends after costs, and then capital appreciation is just picked up with the value of the asset you bought. So if there's capital appreciation in that property, you get an uplift in that real estate investment trust price. Okay, moving on to management. Some terminology for management. Asset management company is a company that manages assets on your behalf. So you pile in your money and they will then manage and do that whole thing for you. A registered investment advisor is someone who gives advice potentially for a fee or for a subscription. He's registered, and the idea is that he's gone through a lot of due diligence. It depends on which country you're in as to how this is actually structured. UK different to obviously US, but the same kind of thing. If you're a registered advisor, you've got your client's interests at heart. You know what you're talking about in terms of terminology, and really the whole point of it is that you're not recommending that a pensioners put all their money into crypto or high risk stuff. You get the idea. The idea is that they measure the risk tolerance of the person they're dealing with, or the client, and then they recommend assets, allocations, and stocks, maybe, or even mutual funds to the client. And they get paid for that, obviously. Stockbroker is somebody who just executes on your behalf. They do have stockbrokers that are execution only. If you look at execution only, it's just a case of ringing up and saying, hey, I'd like to buy £2,000 worth of Apple stock. I'd like to buy £10,000 worth of Diageo, whatever it may be. He does that deal for you, goes to the exchange and does the deal. Some brokers will trade on your behalf, which is a bit of a different ball game. But ultimately, they're just a broker between buying the stock or not. Less likely to need those now anymore unless you're trading perhaps a specifically large amount or an a liquid stock where it has to be worked over a certain period of time. You need that manual intervention. Obviously, all going electronic, it's very easy for us to buy a small amount of stock online. Some terms. A derivative. A derivative is something that derives its price from another asset. So it's not trading on itself, but the price, its valuation, is derived from something else. So, you know, you could have something like an options contract, or you could have an ETF, which is derived from the value of other things. CFD is a contract for difference. This is a contract, literally a contract that says, I will pay you the difference between the buy price and the sell price. You will pay me the difference between the sell price and the buy price. It's ultimately me going long, you going short, and agreeing the magnitude of size. So 1,000 CFDs would be, hey, one CFD contract would be, let's say I went long one CFD at $10. You went short one CFD at $10. We exchanged. That's the contract we exchange. I agree to pay you the difference between the buy price and the sell price, and vice versa, right? So the price goes up to $15. You agree to pay me that. The price goes down to $5. I agree to pay the difference going the other side of it. It's just a contract for the difference in price. Spread bet, similar kind of thing, except in the UK it's the same exposure, but it's wrapped in a different tax wrapper. So it's considered as a bet, and bets in the UK are generally tax-free. So you can spread bet and you can speculate on stock prices, commodity prices, without having to buy the actual stock or the underlying commodity. These are derivatives as well because they're derived from underlying asset, and it's just in a different tax wrapper. Futures contract. The futures contract is a contract between two parties that agree to deliver or receive a specific deliverable. Could be 1,000 barrels of crude oil at a specific point in time at a specific price. So if I buy a futures contract for crude oil from you for $50, that means that with a June expiry, it means that you got to deliver to me 1,000 barrels of crude oil, whatever the futures contract may be, at the price of $50 per barrel at a futures contract, or the future price in the future time, should I say, of June. And the other way around, if you're the other side of the contract. Options contract is, depending if it's put or a call, is the right to buy or the right to sell something, but not the obligation to do it at a future at a price, a specific strike price at a future point in time. So the right to buy XYZ stock at $10 in December. You don't have to, but you can do. So some things there, guys, some useful investment terminology. that might be useful to you if you're just starting out in this trading and investing world. Best of luck, keep your risk managed. I'll see you in the next one. Bye bye.